Okay, finally we're to upstream sales example where there is that difference because of the recognition of the change in the amount of income to the non-controlling interest. And let's see what we got here. This is the example. It's a 25% gross margin, 400,000 is left in the intercompany sale of total 700 between the two, and of course it's an upstream sale. If you do all the math, what you'll come up with is that $80,000 represents 80% of the unrealized profit. That's the 80% owned by the parent. The unrealized profit is a total of, $100,000, thus 80, as we see here. And what's happening is that the parent, when they make their journal entry on the equity method, they are they're lowering the income by the unrealized profit. That's what this amount represents, but only at the 80% amount that it owns. And of course, in the typical, this is a debit, this is a credit. In the typical way the entry works, when we reduce the equity income, the credit is to the investment account. So far, so good. All right. In the year after, they simply reverse that item. They reverse this entry because that's what happens in the next year. It's reversed. The amount is sold. So now they increase the unrealized profit, or they bring it back to realized profit, and they debit the investment account. This is the parent's books on the equity method. Of course, the total amount on the unrealized profit is this 100,000, but they only recognize the 80. Alright, moving forward, let's see what happens. Then the adjustment entries, the elimination entries, are, as we've seen before, first get rid of everything. And don't forget that the two entries we're going to look at combine to what we do in class with the shortcut method being just an easier way to calculate the unrealized profit. So this entry is eliminating the entire intercompany transaction. The second entry here, if this is number 2, this is number 1. The second entry is putting back into, or eliminating, the unrealized profit. And this is the elimination entry at 100% as opposed to the 80% here, because the combined statement is going to show the unrealized profit, which is this number here. Remember, this is a debit, this is a credit. So the unrealized profit, which is there, that's the amount, is simply being deferred until the next year. So 100%, we do need to make some adjustments in how we recognize the non-controlling interest income, but we'll see that in the slide from the textbook in just a minute. Here is the year after, when the deferral of the unrealized profit is being brought back. Notice that the 80,000 belongs to the investment account because that's reversing what the parent did on its books. And here is the difference, the non-controlling interest portion. They call it here, and many textbooks call it different things. I've seen it called, this debit here, as not beginning retained earnings of the subsidiary, because there are no retained earnings when the consolidated financial statements representing the subsidiary. It's simply the NCI, beginning non-controlling interest, since that was the amount recorded last year, and now it's being brought back into total income through the consolidated statement here. So how does this all work out? What are we actually talking about? So we can see it better, these are the entries, but the actual way it's being computed is to see that from the textbook's example. These are all from the textbook. You can find it there, and the facts are simply the following: that this is the amount of unrealized profit in 2014. This is the amount of unrealized profit in 2015. Naturally, this number is reversed over here and brought back to profit. And let's see how that works out. If it's downstream, this is the calculation that the downstream causes for the non-controlling interest, and that is simply that the amount that is the unrealized profit. This is for 2014 right now. The unrealized profit is simply not even bothered, or does not even touch the non-controlling interest at all, so that when you do the amount of earnings totally allocated to the parent in the consolidated statement, it's 80% of this amount from the non-controlling interest. It doesn't even include the 4,000. So the 4,000 comes completely off for the financial statement in recognition of how much of the net earnings belongs to the parent. The 4,000 is deferred completely. So remember, this is the deferral. The next year, this number gets reversed, so it gets added back into profit, and again on downstream, the next year the unrealized amount continues to come off of the parent's share of profit for the year, and so the non-controlling interest amount is only computed based on these numbers. And in this case, the non-controlling interest is 20% here and 20% here in the respective years. Remember, this is 2015. That's a downstream sale, as opposed to the upstream sale, which actually includes in the calculation the amount of unrealized profit. So of this number, 20% goes to the non-controlling interest, 80% to the parent. So there's a difference between the calculation of income of the unrealized, because of the unrealized profit. When it's upstream, some of it gets charged to the parent, the 80%, but clearly, here's the 80% getting charged to the parent, but clearly 20% goes to the non-controlling interest by virtue of the way the calculation is done. Same thing occurs. This gets reversed. Here's the new deferral amount, the new unrealized profit. You come up with a number, you take 80% to say that that's the parent's portion of the subsidiary's income, but that leaves 20% belonging to the non-controlling interest. All right, what does it all mean? Pretty interesting stuff. Okay, and I think that concludes this version.